Hi, YouTube. Today I wanted to explain how to calculate to see if you would qualify for a mortgage. I do a lot of loans, and a lot of people always ask me, how do I know if I can qualify for a mortgage? So I wanted to do a very simple calculation that you can pretty much, plug in your own numbers for your own situation to see if you would qualify. So the first thing that you would need is obviously your gross income, and this is a monthly income. So in this particular example, I have $7,000 per month, and then you would also need your current debt, your monthly debt. So depending on what your future mortgage looks like and your future property tax and property insurance, these will need to be figured out, but you would have your, for instance, car payment, monthly car payment, let's say 250 in this particular case, credit card, and you can plug in a minimum payment amount. And in this particular scenario, it's $150 and student loan of $150. Now, this portion here, the future mortgage payments, I would need to take you down to the loan scenario. And this particular loan scenario would be the purchase price of the property, and then whatever down payment you're making. Now, used to be, obviously, we could have either a low or a no down payment, but nowadays they would require you at least 20% down. So that's why I use the 20%, but obviously you could put down more if you have the cash. So in this particular example, with a 20% down on a $550,000 purchase price, we're talking about a loan amount of 440,000. And I just did a very rough calculation. A 30-year fixed rate of approximately 3.5% currently for a $440,000 loan amount would be $1,975.80. Okay, and I took that figure and I put it up here. The property tax is figured by multiplying the purchase price by 1.25%, and this is in California. Obviously, in different states and different towns, your tax rate would be different, so you just need to plug in those numbers. But as I mentioned, in California, it's 1.25%, and then you just divide that by 12 to get the monthly property tax figure, which in this case is $572.92. And then you will have property insurance. And for an average property, we're looking at around $60 per month. So there you have it. Your total monthly debt would be $3,158.72 in this particular case. And what you do is you just basically figure out what your DTI or debt to income ratio would be, and that is basically, you use the total debt and you divide that by the total income. And in this particular case, your total DTI would be 45.12. Now, many of the traditional banks will only go up to around 43 to around 44%, but you can find lenders that will actually go all the way up to a 55% debt to income ratio. Okay, so I just wanted to kind of, as I mentioned, show you how to calculate this DTI, which would enable you to be able to get a mortgage. So if you figure that your DTI is a little high and you're looking to go to your traditional lenders such as Bank of America, your big banks, Chase or whoever, then you would need to adjust those figures. For instance, your purchase price, or increase your down payment, or in order for you to decrease your loan amount, so that you can actually match around the 43% debt to income ratio. However, if you are looking for if you're going to be going through a mortgage broker, you should be able to get a loan with no problems at 45, even 50%, and as I mentioned, all the way up to 55%. But you really don't want to be in that situation where your DTI is around over 50%, because you would have a very tough time, and basically you'd be working just to pay down the mortgage, and that's not a fun thing. Okay, I hope that this helps. If you have any questions or comments, please feel free to leave them down below. Thanks for watching.